What's up everyone, Tom here with another video. Today, we'll be discussing together our technical analysis thoughts on the S&P 500, NASDAQ and gold, along with the latest stock market news after the FOMC meeting. The Fed continues to say bearish things about the economy, but has Wall Street just woken up to pull a shifty on retail traders? Stay tuned. So as we like to do on this channel, let's take the complicated and simplify it together. One of the ways we can always do that is by understanding the current movements in the market, and heat maps are a good way to do that. Here we have yesterday's performance in the stock market, and we can see it was a mixed bag across the board, with selling generally coming into some of the apparel areas and the real estate area. There's been a bit of a shift in terms of negative sentiment on a lot of this real estate sections, and this makes sense because of course this virus is technically spreading, and while it does, we have not got a cure, and that's hurting really stocks that are specifically timed to the opening of economies. The defensive natures of the week has still been that the tech stocks are still the defensive ones, and when we look at a weekly heat map, that becomes very well apparent and clear. What else have we seen in the market? We've been talking about low volume and we've been talking about put-call ratios. So is this selling going to be sustained? That is the question that obviously all of us are answering, or trying to answer anyway. That can only be told by really Wall Street manipulating the markets to try to get maximum profits. And how do they get maximum profits? Attacking the retail herd, attacking the mental psychology of you and me out there. And that's the thing that sucks about the market. But once we understand that, we can do better. So the put-call ratio has actually increased a little bit, which means that there is a bunch of puts being bought into the market. And I would have preferred that this ratio stayed low at that 1.5 to 1.6 or lower. Why is this? Because the more people that are putting puts in the market, the less likely we are to actually have a crash or to have a significant dip. So for now, the put-call ratios aren't telling us anything other than there is a lot of people starting to come back in with bearish sentiment. What about the volumes? What's happening on the volumes? Well, the volumes were very, very low for the last 2 days. We talked about this in our last video on August 17th, and then August 18th was another low volume day. And that's why I didn't bother making a video last night, because really it was the same thing. Low volume, be careful. We then saw a spike in volumes yesterday with a movement down in the S&P 500 that we'll be looking at together in just a few minutes. Now, what else happened last night? Well, of course, we had the Fed minutes, and they were showing that the FOMC is backing away from their September guidance shift. They're not meeting, of course, their inflation targets at this point. No surprises there. And they're gathering again September 15th to 16th. So that will be an important time in the markets moving forward. I also want to remind everybody that after earnings season, August into September, we generally have low volumes, but we also have negative sentiment usually in the markets. In fact, statistically, September is a very weak month for the markets, and I'll be making a video about that soon. So if that interests you, make sure to subscribe and of course hit that alert button. So the Fed is mostly kind of saying outlook uncertainty, all of the things that we are seeing generally from, of course, Jerome Powell and the Fed in general. I find it interesting, he keeps saying extraordinarily uncertain in terms of the economy actually getting out of a recession. And this is the problem, uncertainty, uncertainty, uncertainty. He keeps saying it, yet no one is listening to that. No one is listening to what the Fed is saying. They're just saying, don't worry, Uncle Jerome has our backs, he'll support the market. So yes, they're supporting it right now, but uncertainty is not really the word I want to be hearing, and they are very much picking these words every single time. Remember, every word he says is documented and very important. So it's those nuanced changes that are happening in these statements that make the difference. So what are we seeing in the markets right now? Well, here we have the S&P 500 is in the SPX, and we'll start here in terms of where the real volume was, and then we'll go to the futures, because I think the futures show us something else as well. So we've hit that kind of high. We've gone around the 3,400. We've mentioned that several times. We've also mentioned that the market likes to pull back to 20 moving averages. And this is the 20 exponential moving average. And we can see twice this level hold. That means that if the market comes back down to this, we would expect buying pressure off this level. And that may be as small as the dip gets. And for scalpers and day traders and intraday traders out there, it might be a worthwhile level to look at. We can also see it's just above that 3,300 zone as well in terms of the moving average. So we'd be looking at a dynamic support with, of course, that physical 3,300 level behind. And we know the S&P 500 loves the psychological 100 zones. It loves stopping just before and just after. That's the kind of thing that generally happens with this market. We can see that through the previous times where it hit that 3,000, found support, and obviously right now it's finding resistance at all-time highs at 3,400 and then 3,200 before that. So the S&P 500 loves the psychological numbers because there's a lot of retail traders and a lot of people are focusing on the psychology of the market, which they should be right now. So what are Wall Street doing? Well, Wall Street are most likely looking at selling a little bit of pressure here and then potentially buying any kind of dips they get. Where are the dips, or where could the dips potentially be? Well, the dips could be at several key levels. One dip could be as short as the 20 moving average. We see here on the futures aftermarket, we got further selling pressure today, as we notice here, than the actual close itself. Let's see whether tonight the S&P 500 can hold that selling pressure or whether we just see a very quick bounce. That will be really a key on sentiment going into the next couple of days and next week of trading. The 3,300 remains that 100 zone. And then of course, there's a big kind of support line through here at that 3,220, 3,200 zone. So I'd be drawing kind of a range in there. And why would I draw a range? Well, it's good to have ranges and alerts. Between the 3,200 and the 3,030 is definitely going to be key zones for the market. And this will have dynamic 50 EMA, which we have not touched for quite a while now, but we know the market can get down there. And a lot of buying pressure coming off the previous peaks. And this specifically is very clear when we go to the weeklies. We know that the market struggled through this zone. So if the market was to pull back, it would most likely try to come to this zone as a deeper form of pullback. And that's usually what we see in these markets. So what else can we do to find out whether that zone makes sense? Well, one of the things is, of course, Fibonacci retracements. Do we have a Fibonacci retracement in that zone? We talked about how previously when we had an all-time peak and then we had a pullback, which we'll look at in just a minute, it came back to the 38.2 zone. The 38.2 zone is smack bang in the middle of this range. So this, from the last move up, will be something that many traders are looking at, specifically big traders. What happened previously when it hit those highs? This is 2018 to 2019. Well, if we draw a fib of that and we draw a fib of that move up there, we'll notice that the market came to a 38.2 and then it bounced up. In aggressive trends, 38.2 fibs are one of the best because it hasn't come back too far to start hurting sentiment, but it has come back far enough to allow value dip buying in the trend. Do we know the stock market's going to go up over time? Generally it will. That's the nature of stock markets. So that could be a good dip buying zone. And of course, you'll need to make your own investment decisions based on those kind of things. Now, what else could be happening as 3,200, 3,230? Well, the thing that could also be happening is we might see the weekly 20 exponential moving average moving up as well. And why is that important? Well, when this moves up here, we'll be getting the market coming back down. And we know that this is one of the most important moving averages in a healthy trend. And I state healthy because this trend is not healthy right now. And that comes very clear when we look at some of the stocks like Apple and Tesla in the markets. They're very far away from these weekly 20s. And I encourage you to put them on the charts, have a look at that and say, wow, this is so far away. Does that make sense? Look over here between 2016 and 2018 trend. It came back very many times. And when it got too far away, we saw that pretty big kind of crash coming off that level because it moved too fast, too quickly. And this will be repeated time and time again. And why? Well, because it's the nature of human psychology. When the retail investors get involved, like you or myself, we always push the markets a little bit too extreme. And it shows in things like gold. We spoke about how this is in a blow-off phase right now, and the top is in for at least the short term. Why do we know this? Super aggressive move up, super far away from even the daily 20. It sold off super heavily. And we mentioned this week quite a few times that we expected it during a blow off to come back between the 61.8 and the 78.6 fib and then sell off again. It's done so now, and it could potentially even put pressure back down to this 50 in terms of around the 1900 zone. That is possible. and we expect further big volatility in gold. It's the nature of having retail investors and Wall Street manipulating the market all at once. I still state that Tesla is another thing that you want to be looking at. Apple and Tesla right now have some of the most explosive moves. And while it's normal for Tesla to have explosive moves, the previous resistance of 1680 now becomes the support. And we would expect that the market would probably start to sell off, come back down to this level, hit the 20, and at the same time as this sentiment happens, we'd be seeing that dip in the S&P 500. But what becomes more important here is that if Tesla is able to get under these zones, then it suddenly could come all the way back to 1370 and start to really hurt retail investor sentiment. Remember, if something comes down too much, everyone starts worrying. And that is what causes the fear in the market and causes those next big moves. So for now, it's still really a pretty set uptrend, but of course, Wall Street could be getting involved in pulling a Shifty here, and they could be set to sell even further. But the key zones remain on that S&P 500, that kind of 3200 to 3230 level. What are the fund managers saying? Well, they're saying that they're very optimistic on stocks and that they're very excited about getting into them. That's never a good thing. Whenever you see articles like this, you usually want to run. And you'll notice this article was actually first published on August 18th. Notice how the market sells off right after these articles happen. This kind of thing is always the way it is. Whenever everybody becomes uber bullish, then it goes bearish. And that comes with that sentiment of what happens in the market. What other things are people saying? Well, a few people have got this idea of maybe they should be taking profit right now, which is potentially what's happening, and that there is going to be a dip and then, of course, a super boom. And super booms will be caused by the Fed, the fiscal policies, and everything else going on. I think it's pretty clear that we have basically a put underneath the markets. We all know this. The Fed has supported the markets and will continue to do so for the foreseeable future. So as long as they hold sentiment up and they hold obviously this idea of unlimited liquidity up, we could be seeing markets moving more bullish for the foreseeable future. So hopefully this helps everybody today. If it does, make sure to subscribe and of course hit that alert button. And always remember, knowledge is empowering, but only if you act on it. Stay healthy, stay safe. We'll see you in the next video. Bye for now.